Hello friends and welcome to the new episode of Market Expert series. Today we have with us Mr. Amit Nadekar, a senior fund manager at LIC Mutual Fund. He is a chartered accountant and has done MMS in finance from Jamnalal Bajaj Institute of Management Studies or the prestigious JBIMS. He has over 21 years of work experience. Prior to LIC Mutual Fund, he was with Alchemy Capital Limited. Before that, he worked with Raymond Limited, ran his own equity research KPO and also oversaw US equity funds on the sell side. So please join your hands in welcoming Mr. Amit Nadekar. Welcome to the Market Expert series, sir. It is our pleasure to have you with us, sir.
My pleasure. Thanks for having me over.
So let us take this discussion forward and ask you some questions. Sir, what do you make of the market going forward, considering that our economy seems to be doing much better than other economies?
You must have heard about this saying that, markets are slaves to earnings, right? If you look at last 20 years, the market has given on an average a 12% return. And over the same period, the earnings have also kind of grown at 12%, right? If we have to use this analogy to understand how markets will behave going ahead, the consensus is projecting, Nifty earnings to grow at 15 to 20% over next 2 to 3 years. And there is a strong, basis to, go by that prediction, right? So to answer your question indirectly, ceteris paribus, I think, we should have a healthy returns, over next 12 to 14 months.
So as sir said, the equity markets look attractive over the next 2 to 3 years. The economy looks well poised for a good growth. So you should start investing if you have not already done so.
Yes.
Coming to our next question, sir. A lot of people have been investing in the traditional tax saving instruments such as PPF, NSC, etc. What is your view on the performance of ELSS and who should invest in an ELSS? Could you throw some light on that?
So, if you look at, the returns which you can generate from, a product like PPF, right? It's around 7%, correct? Now, if you look at, like you just mentioned, the equity markets over a longer period have given 12% odd return, which is a 5% higher rate compared to, let's say, PPF product, correct? If you look at ELSS category, on an average returns, over last 10 years, 15 years, you take any time frame, would be in the range of 15 to 20%, right? So substantially higher than, let's say, the return which you would get from, PPF, right? Again, a PPF would have a 15-year, lock-in, correct? Compared to that, you have a 3-year lock-in on a ELSS product. So liquidity is far, far superior. But I think far more important thing is that, your ability to beat inflation and generate substantially higher wealth and an inculcate habit of saving through ELSS, because every year you would be probably getting benefit on ATC through 1,50,000 up to that level, right? So ELSS, I think, hands down beat a product like PPF.
As sir rightly pointed out, ELSS has the lowest lock-in, has generated the highest returns over the long term. So it's a very attractive instrument. If you have been using traditional instruments, you can switch to ELSS. Of course, there is a little bit of risk involved. So you need to be careful and invest accordingly. Sir, next question for you is, what is your view on goal-based investing?
See, money is not an end in itself, right? Money is means to achieve far more important things in life, correct? So there could be, higher education for your, kids. A marriage could be an important, event which needs, far more, money, right? Your dream house or your dream car could be, important, things to pursue and fulfill, right? Similarly, there could be a lot of passions or, things in your life. Probably you are postponing today because you need to work, 12 hours to earn the bread, right? So if you are financially independent, you can pursue those passions, right? A goal-based investing will allow investor or any person an opportunity to systematically plan to earn enough money to achieve his goals, dreams, right? Again, like I mentioned in case of ELSS, a goal-based investing will help inculcate habit of saving and not wither away from his achieving his goals. So for example, if you are putting money in equities without any goal in mind and tomorrow there is a recession fear, you will pull your money out. But instead of that, let's say you're putting money for as simple a goal as, let's say, buying a car, and for which you would have calculated that it takes 7 years, you will stay put in the market and not disrupt the compounding of, wealth, right? So that's, I think, very, very critical, that money is not in itself, but it's a means to achieve your goals.
Well said, sir. So, goal-based investing helps you to stay invested longer, inculcates the investing discipline.
Yes, absolutely.
And also helps create wealth in the long run. So, it's always better to have a goal-based investing. Coming to the next question, sir. Sir, LICMF is coming up with its multicap fund. So, as per you, how different are multicap fund, flexicap fund and large and midcap fund categories from a return perspective and a risk perspective for an investor?
Sure. So, the large and mid cap category has done phenomenally well, no doubt about that. But if you see the composition, it's 65% large cap and 35% mid cap minimum, right? If you look at large cap, it's predominantly, of course, by definition, large cap, right? And you miss on the opportunity to invest into mid caps or small caps. If you look at, the history, right? And if you were good at stock selection, you would have made far higher wealth, picking a company, a quality company early, right? So for example, in early 2010, Bajaj Finance was, a 2,000, 3,000 crore market cap company. And today it has multiplied more than 150 times, right? So that opportunity would be missed if you're just, investing into large mature business, which have a lower rate of growth and, less ability to, scale up in multiple times, which a small business can, right? A multi-cap fund by definition would have a 25% minimum allocation to large cap, 25% minimum allocation to mid cap, and 25% minimum allocation to small cap. So you get, opportunity to invest across the spectrum of market cap companies, right? Across the spectrum of different stages of businesses in their life span, right? And also, far more important is that it takes away, the underperformance which one might see because of, a fund manager's call going wrong. So we have heard this multiple times that, timing is very difficult, right? So staying all the time, always invested in each of these buckets will help you not getting into, a phase of underperformance because of, let's say, your call on, any of these buckets going wrong. Yeah. So I think it's a beautiful product which will help you add far better alpha compared to large and mid cap, if of course the stock selection is right.
Great. So these are the differences between a large and mid cap fund and a multi-cap fund. If you are looking to stay invested for the long run and want to take a slightly higher risk, multi-cap is the way for you forward. Coming to the next question, sir. Which sectors according to you look the most attractive for the next 2 to 3 years?
I think there are multiple themes to play in Indian markets and there are several opportunities across the categories. But I think few of them stand out today. One of them is, automobiles, right? So if you see, it's a cyclical sector, but at the same time, a long-term structural story in a country like India, where probably in, 3-4 years, we will cross a $3,000, dollar per capita income, and post that you can see a hockey stick effect on consumer discretionary spend, right? So since 2018 auto sector has not gone anywhere for multiple reasons, right? But I think things are turning there. You have order books with a 12-month 15-month waiting period, so demand is extremely robust, right? They are constrained today because of some of the supply side bottlenecks, right? But every month, every quarter, I think those are getting addressed. Correct. So you have very high visibility. Margins today are suppressed because of higher commodity prices. So you will see over next 12 to 24 months margins actually getting improving, both because of higher volumes, operating leverage, and commodity inflation receding. Right. So I think it's a great sector to invest at current point of time. Similarly, I think industrials, which I think we had a lost decade on that is also playing out extremely well. What we saw over last few years in chemical space in terms of China plus one, we are seeing that playing out probably in manufacturing sector today. Also, all government policies, BPLI, are aligned to this sector. So that's another important, I think, sector to look at the current juncture.
Wow, awesome. Even I am bullish on those sectors, sir. So as sir said, automobiles look attractive. You can see value unlocking in them over the next few years. Also, the industrials look attractive with the government PLI schemes and other schemes being in favor of them. They look very attractive. So coming to our last question today, your words of advice to our investors for making a well-informed investment decision.
I think we already addressed it in one way, right? I think the point about the goal-based investing is something investors should keep in mind, right? And in terms of information-based decisions, right? It is very important to understand that India's structural growth story. It is important to understand that equities as an asset class has been turned out to be best asset class, not for few years or decades, but over centuries, right? That's the only asset class which consistently beats inflation and allows you to generate wealth. Once you understand, I think these two factors, it's important to put money on the table, because if you don't put money on the table, you are not in the game, right? And then just allow a long-term compounding of your savings, right? And the goal-based investing will help you, plan well and stick to the plan well, right? So I think that's, few words of advice from me on investing.
Thanks a lot, sir. It was a great piece of advice. We will surely try and adhere to your advice, and surely it has helped our viewers as well. Thank you for coming here and being with us.
Thank you for having me over. Thank you.
And to our viewers, hope you had a great time listening to the valuable insights from Mr. Amit Nadekar. Please join your hands in thanking him for this wonderful experience. And keep following grfinvisors for more such interesting videos, updates, and you can also share your questions for our next Market Expert series in the comment section below. Thank you.